Hello everyone and welcome to this video on 3.9 budgets. So 3.9 comes right at the end of the finance and accounts topic, and it's the last chapter, and this is an HL only topic, and therefore you should only be watching this if you're an HL student. Well, you can watch it if you're an SL student, but you don't technically need to know it. So there are 5 learning objectives. Basically, we're going to do 2 main things, which is how you make a budget and do some variance analysis. And then we're going to talk briefly about cost and profit centers. So firstly, what is a budget? Well, a budget, you might have used these in your life already. I certainly used them in my life. It's a plan for future finances, and we look at income received and planned spending. So I'm going to show you how to do one in a minute. But basically, we're going to list all predicted income sources. We're going to list all predicted expenses, and we can do this for some time period, whether that's a week, a month, or a year. And these can help us do various things. We can identify possible possible problems in the future. So if our expenses are higher than our income, then we're going to see that, and therefore we're going to have to solve that problem. We can set targets for income or trying to minimize expenses. And then we can also make decisions over how we spend money. And like I said, we also do these in our life. So for example, maybe I go to the cinema tonight and I say to myself, well, the total cost for tonight is going to cost me 30 euros. So therefore, I'm going to need to have more than 30 euros in my pocket. Maybe I'm going to need to have 50 euros in my bank account or in cash. So therefore, I'm not going to run out of money. So let's move on to what a budget looks like. So again, we're going to predict expected future income and expenses. And in order to do this, maybe we look at past data, or we look at predictions of what performance is going to be like in the future. How we actually come up with these numbers is kind of a topic for another video. But in this situation, from the perspective of a company, this company is predicted that their revenue for next year is going to be 120,000. Again, so this is budgeted for next year, which means these are our predictions for the numbers next year. And therefore, our total income is going to be 120,000. In reality, there's going to be multiple income sources. But just to keep it simple, this video, I'm just assuming that the only income is going to be revenue. And then what we can do is we can list out all of our expenses. So this business is predicting, they're budgeting 25,000 spending on salaries. They're going to buy raw materials for 18,000. They're going to spend 13,000 on marketing, and then rent will be 20,000. And then we add all those together to get total expenditure to get 76,000. And then we can have some sort of prediction or budget for what our profit's going to be. So we do the 120 income minus the 76 to get a profit of 44,000. Now, at this stage, if you're thinking this looks just like a cash flow forecast, kind of does, doesn't it? It's kind of fairly similar. And so there are a lot of similarities between them. I think when we did the cash flow, it was a little bit more detailed, but there we go. There are certainly similarities here. What we can do next is we can look at something called variances. So variances are when we look at the difference between the budgeted number and the actual number. So let's just go through exactly what those mean. The budgeted number for next year, this is the number before the year starts. We predict what we think the revenue is going to be. So at the start of the year, we think this year we're going to make 120,000 in revenue. Then at the end of the year, they calculated how much revenue they actually made, and they've worked out that they had an actual revenue of 130,000. So the budget number, this is the predicted number for the future, and the actual is the actual number at the end of the year. And then in this situation, they've done the same thing. So we've got revenues 120,000, actuals 130,000. For salaries, they budgeted 25,000, but actually it was 28,000. Raw materials budgeted was 18, but they actually spent 20,000, etc., etc. Then what we can do is we can calculate variances. Now, variances, like I said, is when we have a difference between the budget and the actual number. So with the revenue, we budgeted 120, the actual was 130. So the variance is just the absolute difference between these two numbers. So we can just do 130 minus 120,000 gives us 10,000. What we can then decide is whether this difference is adverse or favorable. And in this situation, we're saying that this is favorable. Now, here's why. And it's because we predicted we would have 120,000 in sales this year. but we actually got 130,000. And what that means is we actually sold more than we were expecting to sell. And therefore, that's favorable. When we're talking about income, it's favorable if the actual number is higher than what we predicted. So there's two things here. The variance is the difference between the two numbers, and then the adverse or favorable says whether this difference is good or bad, basically. Adverse being bad, favorable being good. We can then do the same for all of the expenses, but there's a slight difference here. So for example, with the salaries, we budgeted 25,000, but actually we had 28,000. The variance is the difference, which is 3,000, but this time the difference is adverse, so it's negative. So in this situation, the actual was bigger than the budget. And with expenditure, generally, if we spend more than we were planning, then that's going to be a bad thing. So therefore, it's adverse. So can you see that for income and expenditure, it's the other way around. So with revenue, the actual was higher, but that was good because it's income. With the salaries, the actual was higher, but this is bad because it's spending. And we don't want to spend more than we're budgeting. And then we can do the same thing for all the others. Now, marketing, the actual was actually lower than the budget. And because it's an expenditure, we can say that this is favorable because we spent less than we were predicting to spend. So we continue doing this. We can see that the total expenditure was 4,000 adverse, which means that we spent 4,000 more than we were planning. But overall, the profit was 6,000 favorable, which means that our profit was 6,000 more than we were expecting. So the actual being 50,000 and the budget was 44,000. So just to summarize that, so for the variances is for the income, if the actual is bigger than the budgeted, it's favorable because we want to get more than the higher the income, the better. If the actual is less than the budget, then it's adverse. And the expenditure is the other way around because it's a cost. So if we actually spend more than we budgeted, it's adverse. If we spend less than we budgeted, then it's favorable. So why are budgets important for businesses? Well, just like for people, they're beneficial. We can plan for the future. Businesses can allocate resources, and it's also a way of controlling spending. So if you tell people you've got a budget, so you can only spend 13,000 this year on marketing, then the marketing department will know, okay, we have some sort of limitation. We can't spend all we want to, so we're going to have to make decisions about how we spend it. So limitations is it can lead to a certain lack of flexibility. So some people might think, okay, we must stick to the budget, but in reality, sometimes it may be better to actually deviate from the budget. Maybe during the year, they realize we should be spending more on marketing than the budget said, and that's going to be beneficial for our company. But if we stick to the budget, we might not actually benefit from it overall. It can lead to short-term focus and also may lead to unnecessary spending. And the reason for that might be, let's say the marketing department gets to the end of the year and they've only spent 9,000 out of the 13,000. And they think, well, hang on, we've got another 4,000 in our budget, so we might as well spend it. But in reality, maybe they don't need to spend it. But if they do end up spending it, then maybe they won't be using it effectively because they didn't need to spend it in the first place. Okay, on to the last thing, which is cost centers and profit centers. So cost centers are when we can take a section of the business and we can allocate costs to it. Sounds a bit strange, but let's do some examples. So for a hotel, we can, examples might be the cleaners, and also the reception desk. So for example, when the hotel cleans the hotel, they're going to employ cleaners to actually do that, and they can allocate costs to the cleaning department because there's going to be costs involved with paying salary, buying cleaning supplies, etc., etc. It's the same with the reception desk, where they actually need to hire people to work on the reception desk. Profit centers is very similar, but in this situation, we can allocate both revenue and cost to that part of the business. So in this situation, maybe the hotel restaurant, maybe the hotel bar would be profit centers. And that's because in this situation, the hotel restaurant will have costs because they've got to hire chefs, waiters, food, etc. But also in this situation, they can collect revenue because people will spend money to go to the hotel restaurant. And therefore, the hotel restaurant itself will have revenue, will have costs, and therefore the restaurant itself will either generate a profit or a loss. And therefore, they can call it a profit center. It's the same with the hotel bar. The hotel bar will make revenue from selling drinks and food, but also there'll be costs involved with staff and buying supplies for the bar. This is in contrast to the cleaning department, where the cleaners, it's only a cost. There's no revenue raised from actually having cleaners at the hotel, but clearly cleaners are needed in order to make the hotel rooms good. But the hotel actually makes money from the rooms, not from the cleaners itself. So why are cost and profit centers important? Well, basically it allocates responsibility for different parts of the business. So if there's a manager of the restaurant, then that manager of the restaurant will have responsibility for running the restaurant, and that manager can be evaluated on how well they run it. So you can identify poor performing areas of the business. Maybe the rest of the hotel says the bar's not making enough money, so therefore we need to do better there. But also you can use it to reward strong performers. Some limitations might be, well, some managers might end up running their part of the business or their profit center rather than focusing on the business as a whole. So maybe the hotel restaurant manager only focuses on the restaurant and doesn't make decisions for the best of the hotel overall. Also, some costs can't be allocated anywhere. So, for example, if you look at the lighting for the hotel sign, I'm not sure whereabouts that would actually be allocated. So sometimes not all costs and revenue can be allocated. Okay, move my head and you can see we've now finished that chapter. I'll see you next time.